Hey guys, so let's now take a look at some of the external sources of finance that can be used by businesses. So first up, what is external finance? Well, of course, it's finance raised from outside of the business. Now, firstly, we've got owner's capital. Right, so why is owner's capital from outside of the business? Well, if the business is a medium or larger sized business and is therefore a LTD or a private limited company, introducing owner's capital from outside into the business is clearly external finance. All right, now you could argue this is certainly internal finance if it's just a sole trader or a partnership, however. Okay, nevertheless, this is money injected by the owner. There's no interest charged, but of course there's going to be limited means there. Okay, let's move it on. Let's have a look at loans. So this is of course money lent by a bank with interest which is charged to the actual customer, in this case the business. You pay in installments. However, there is no loss of ownership. There is no divorce of control through selling shares. You keep and retain control over the business. That's a biggie. Okay, next up, interest charged can vary depending upon the Bank of England's base rate and the way in which that actually changes. Okay, and it must be obviously repaid in full. Now, moving on, we've got crowdfunding. Okay, so crowdfunding is about attracting investment from a large number of people with small individual amounts. Now, this can operate in two different ways, really. So firstly, it could be that you choose to actually offer incentives for people to invest in you via a website like Kickstarter. So if you want to crowdfund a particular type of product, then you get people contributing money and you will give them the product and perhaps signed edition or whatever. Or alternatively, it could mean through websites such as Crowdcube that you actually give away part ownership of the company. So you give away a share in ownership of the company in return for that funding. It's well worth checking out both of those websites, by the way. It will give you a really good understanding how crowdfunding works, and you'll see some interesting projects on the line there too. Right, so this is going to mean that of course you can raise a large amount of money. There's going to be no interest payable on this money either, so that's good news. However, there can be that loss of control and there's no guarantee that enough money will actually be raised, of course. Right, so then we've got mortgages. Well, these are entirely appropriate for long-term borrowing to buy a property. Okay, so to buy buildings, it's absolutely 100% fit for purpose, really. Okay, the large amount can be obtained. There's again no loss of ownership, and we see that yes, interest will be charged and it is secured against the asset. But because it's secured against the asset, and i.e. if you do not keep up with your repayments, you could have that asset seized. Well, that does actually mean the bank will offer you a much lower interest rate than, say, perhaps with a loan. Okay, but a loan is probably more appropriate if you just want to buy a new car or a new piece of machinery. Right, moving on. Then we've got venture capital. Okay, so venture capital's about specialist organisations that actually look for firms with high growth potential, and then they will be prepared to invest in those firms to really help direct the growth of those firms, as well as enjoy the success that would obviously bring the venture capital. So investment from a firm which specialises in fast growth, they will expect part ownership of the company though. Okay, so finance is offered by experts who will provide really good advice. You're going to get specialist support there. Okay, but there is going to be that loss of control, and they will want some of the profits as well, of course. And then finally, we've got debt factoring. So this is about selling business debts to a debt collection agency. Okay, so the way in which this works, imagine £100 debt. So you sell that £100 debt to the debt collection agency, and then they give you 80% of that money. So you get £80 of that £100 of bad debt that you otherwise would have struggled to get back from one of your bad customers. So that can make sure that a bad a bad debt is turned into a better debt, and that you actually get some cash flow in from that. So it provides that cash inflow. The factoring company takes on the risk of actually collecting that £100 back, and so you see that you only actually receive a percentage of the overall debt. Okay, so that's the downside. Right, great stuff, guys. Thanks ever so much for joining me. See you next time.